Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Handford, one of the managing partners of PassiveInvesting.com. With us today is Dan Krueger. Dan, welcome to the podcast.
Thanks for having me on. I've been excited to come. I've been consuming your stuff for a long time, so this is going to be a good conversation.
Awesome. Well, looking forward to diving into this Origin Properties, 34 units that you acquired recently out of Minneapolis, Minnesota. We're going to dive into that in just a moment. But before we do, just tell the listeners and share with us a little bit about yourself and your background and kind of where you are right now in the multifamily space.
Yeah, absolutely. So like Dan said, I'm Dan Krueger with Invictus Capital. We've been around for about 6 years now. It's about how long we've been operating in the multifamily space. It's been effectively the same thing over and over again. We find good quality properties in good areas that have some upside potential to them. So, the usual kind of value add type of deal. We take these down, execute the business model, and within, 2 to 3 years, execute a cash out refinance, and then end up holding about 5 to 7 years on average for most of our deals. And we've been just hyper focus on our area. It's a great area, and we're vertically integrated, so that's part of the reason why we focus on this area. Try to keep as much in-house as possible. But I come from a corporate finance background, so studied finance, been obsessed with investing and anything trading, markets, investing related for my entire adolescent through adult life, and ended up realizing that the corporate finance route just wasn't serving me. Didn't feel motivated. And it was around that time that I started doing a deep dive on real estate, specifically multifamily, and I got hooked right away. As you know, the more you learn about it, the more it becomes a no-brainer. And so I left that, didn't have kids yet, so moved into that full time. And then shortly thereafter met my current partner, Anthony Vicino, who I think has been on your show before. Actually, I think he was on a little while ago. And, ever since we got together, it's been, just exponential, just the combination of our skill sets and, having the same goals and just being really perfectly aligned has been really powerful. So.
Well, that's exciting. So let's dive right into this property here, the 34 units out of Minneapolis, Minnesota, called Origin Properties. So let's dive in first and tell us about the acquisition process for this one.
Yeah. So this one was a result of good relationships, which has been the story for all of our most recent deals. Like I noted, we've been hyper focused on this one market, and so during that time, we've developed a lot of really, really great relationships with the brokers here and a lot of the big owners, specifically those in the older end of things who've been accumulating portfolios for 15 to 30 years. And they're starting to get to that point where they're either, 1031ing into, CVS's or Starbucks, triple net stuff to go, really, really easy on the management side, or they're just starting to offload and exit. There's, a pretty big demographic switch going with respect to wealth right now. And on top of that, the last couple of years have been pretty crazy, and that's kind of expedited some of these guys' timeline for repositioning themselves. And so we've positioned ourselves there. And so that's really where this deal came from. This came to us technically through a broker that we had a really good relationship with, but it was still off market because that's kind of the way he does his stuff. Is he knows all the owners, and he's got a couple guys who he calls when something pops up, and so he does pocket listings and really great relationship. So he put us in front of this guy and put a really good word in for us. So he didn't really show it to anybody else. So we got to pick this one up at a really good price for that reason.
So when was the first time you kind of toured this property?
Let's see. This one, I believe we started looking at in person probably late April, I think, mid to late April. And so we're really occupied with another acquisition at the moment. And so this one kind of came pretty close to another one. But yeah, I think this one was around April, and then we ended up closing mid-July on it.
This one you closed in July, so it's pretty fresh in your mind here. Yep. What was kind of the offering process on this one? So like, what was your kind of initial offer? What was the asking price? Kind of where did you end up through that?
Yeah, so this one was nice because the median price per door in this area for this type of product was around $127,000 per door. And so the whisper price on this one, I believe, if I remember correctly, or not even the whisper, basically what the broker told us the seller was trying to get was, I think, 109, 110, somewhere in there. And we came in at like 106 and ended up doing it at, make sure I get this correct. we got two deals around the same time. One was 106 a door, one was 107, and this one was the 107. So yeah, we ended up getting at 107 a door, which is a really great basis considering where things are trading these days. So that plus the upside potential, plus how great the properties were, made for a really nice asymmetric risk reward situation.
And so did the seller accept your first offer at 107 a door?
I think we came in at 106 a door and then ended up coming up to 107. So there wasn't a whole lot of haggling. I mean, honestly, all those prices would have worked for both parties. When you get to numbers like that, where it's, $1,000 a door on 34 units, it's not, I think it's more so about just the ego on both ends. It's like everyone kind of wants to get their number, but it doesn't really make a big difference at the end of the day. We probably would have been able to, we definitely would have been able to do it at 110 a door. It still would have worked, but everyone gets kind of emotionally attached to their number. But yeah, it was the seller on this one was great. Really reasonable guy, really liked us, really wanted to keep doing business with us, and that feeling was mutual. So no one was really coming into this one hot, really aggressive. It was like we both wanted to do the deal, and did a little quick negotiating, but at the end of the day, it was a good setup, and so it was a very easy negotiation process on this one.
So right at 3.638 million is the kind of purchase price on this one, right?
Yep, that's it.
At 107 a door for the 34 units. And I know you said you mentioned it was off market, but was there anybody else that the broker had kind of given it to as a pocket listing to kind of make an offer on it? Or were you the only group that were offering on it?
Yeah, on this one, it was just us. That broker typically, when he does these types of deals, it might be one or two other groups that he'll show them to. But on this one, this guy had a really kind of specific timeline. He was 1031ing into a triple net property because he was getting to that point where he's about to retire and wants to start going into some stuff that's as easy as possible to manage, and obviously doesn't want to take the tax hit. So he had a really specific timeline. And the broker really coached him from the perspective of, these guys are closers. They're not going to, mess around during the process or retrade. If they say they're going to do something, they will. And so he just wanted to, get this done as efficiently as possible. And for him, it wasn't going to be worth it to try to get a few thousand dollars extra per door, and then lose that confidence from someone just in the market. He wanted to know who he was working with and know exactly, when this was going to close. So his timeline didn't get screwed up.
Sure. So now we got this thing under contract. We're going into due diligence. Any surprises or gotchas or anything like that happened during the due diligence that you had to handle?
No, honestly, I think during the physical inspection, things came back little better than we expected when we actually did the walkthroughs of each unit. Because, you look at a property initially, you go into a few units and you kind of assume, okay, they probably showed us the best ones. But when we went through and walked each unit at each property, we were actually pleasantly surprised that the amount of rehab work in the units was actually coming in a little bit less than we had expected. So everything looked good on that department, no surprises. Like I said, we were dealing with a guy who wants to keep doing business in the future. So typically those guys, if there's anything worth knowing, they're going to tell you right up front because they're playing the long game. He's got other properties that he's going to want to sell to us, so he's not going to try to save a couple bucks and keep some bodies in the closet or anything like that.
Sure. And what's the plan for renovations on this property?
Yeah, so our approach with these is always consistent across the board. Ever since COVID, we've taken the approach that we want to get things that are relatively stabilized, but they still have upside potential, basically so that we can try to keep occupancy as high as possible and get our units renovated and relisted at the market rent at a very modest pace, really, to keep that cash flow nice and high. And so the renovation process is to do just that. On average, in these types of properties in this area, about 30% of units will turn over in a year just from people organically wanting to move for one reason or another. And so it's at that point that we'll pop in and do our renovations, get them up to market rent. And so lease renewal letters are going out actually this week or next week. Actually, I got to check with my manager on that. But we've got those structured in a way that we've got those new expirations coming up in a timeline that fits for us, so that over the first 24 months, we'll have worked through the vast majority of these units. There's usually going to be a few people that hang around, the lifers that just kind of are always with the property. But generally speaking, we're going to get through the vast majority of the units within the first 24 months and then be set up to go back and refinance before the Fed starts changing things.
Sure. So how much are you planning on putting into the renovations for the interiors of these units when you're doing these turns?
Yeah, actually, on average, only about 4,000 some dollars. There's several units in there that were in, really good shape, and only 20% of the units actually needed pretty significant upgrades to them.
Mhm.
That's the nice part about getting these properties from operators who are taking care of them. We're not getting, the value add boost because there is deferred maintenance or because the operations were inadequate before. We're getting the upside in the rents because this owner, as well as all the others that we've purchased from recently, have really prioritized ease of management. And so, to do that, they keep these really great tenants in there for long periods of time, keep the rent right nice and low. But when you go in, they've got great people in there, and things aren't really getting beat up. So we're doing, some pretty basic appliance packages, some new, flooring in the kitchen, trying to get rid of as much carpet as we can. But like I said, there's only about 20% of the units that are going to require, around 6,000 or up to $7,000 in the renovations. And then the others were, pretty minor, just a couple of appliances, some paint, some cleaning. So nothing too extreme needed. We just need to, get them up to par with the rest of the market because there's a pretty big delta.
Where are the current market? What are the current rents right now? Current kind of average market rents?
Yeah, on average in the building at the time of acquisition, one bedrooms were getting about $848. Market rent was about 1,000, 1,005. So they're basically getting about $1.33 per foot in these units, and it should be more like $1.50. It was $1.51.
Mm-hmm.
Yeah, $1.55 actually is where the rest of the market is on a per foot basis, and they're only getting $1.31.
And then, does this property only have the one bedrooms, or that they're kind of is there a different mix as well?
There's two units that are two bedrooms as well. But those weren't the delta on the rent was about the same. The two bedrooms we're looking at about $160, $150. So pretty much the same delta.
And I know sometimes when you buy properties like this from kind of an older, owner or whatever, kind of a smaller mom and pop, sometimes they have a lot of residents that are on month-to-month leases. Mm-hmm. Is that the case on this property, or are most of them on long-term leases?
Yep. Yeah, there was a decent amount of month to month. So the renewal letters I mentioned before that are going out are, starting to get people staggered in a cadence that aligns with our business model. Obviously, there's going to be some variance to that. Not everyone's going to come and go exactly when we want. But getting, the tenants, now that we've had the properties for a couple of months, so we've got a really good idea of, okay, who are the guys that we really want to keep forever because they're amazing, and who are the ones that maybe we wouldn't mind if they weren't here anymore. We kind of factor that into the equation along with our pro forma and, stagger things so that they're coming on online in a manageable order with, not everyone, we don't want to have like a ton of units in 1 month. Obviously that would be a little bit disruptive. So we've got those structured in a way that they're going to come across for renovations in a nice cadence over the next 24 months.
Mm-hmm. Another, and you may already be doing this, but another thing to do too is as you're, if you wanted to push more of the month-to-month leases to long-term leases, even right now, you can still stagger them by doing, 13 or 14 or 15-month leases instead of just 12-month leases as well. Kind of space them out, if you will.
Yeah, and that's especially important for us because in our area, it gets kind of cold for part of the year, and so there's some inopportune times to go out and start leasing units. So obviously, we want to get those in the prime leasing months would be the spring, summer, and fall, and then try to minimize how many that we have expiring in the winter. Obviously, we want 0 in the winter, and then we do have no winter move-out clauses to try to protect against that as well. But we've got the weather to take into consideration, as well as trying to incentivize some of those people to stay, but also have them come at a time that's appropriate. So.
Mm-hmm. So talk to me about the supply chain right now. I know you probably haven't started renovating some of the units just yet, but any supply chain issues?
Always. Yeah. We've got plenty of other properties that we're mid project in. And so it's getting better, I will say. Last year in the summer was probably the worst. We were having to get appliances shipped from across state lines, paying way more than we used to, and things would just take forever. So things have gotten a lot better. However, there are still a lot of costs that are high, just on materials in general. And there's still some stuff that's a little tough to get here and there with, I know we've had some issues with some paints that we've been using. So it's getting a lot better, but it's still not quite to where we were back in 2019. It's still a pain. I'll say that.
Mhm. What about property management? I know you mentioned kind of being vertically integrated. I think you mentioned earlier, maybe not since we've been on recording, but in kind of, I call it the green room, I guess, if you will, before we started recording, we were talking a little bit about you're being based in the St. Cloud area. Is that correct?
Minneapolis, St. Paul, so the Twin
Okay.
Cities.
Oh, St. Paul. I was thinking St. Cloud for some reason. I have some friends that I have in St. Cloud because I've flown
Okay.
into Minneapolis before and taken the hour and a half drive or so to St. Cloud. But so you're basically just right there in kind of that St. Paul area already.
Yep. Yeah, exactly. So
Okay.
most of the portfolio is concentrated in St. Paul, and then we've just started branching into Minneapolis. So the deal we're talking about today, it's called Origin Properties because it is the first partnership with our Minneapolis partner, and so our first Minneapolis acquisition, first of many. We've wanted to get into Minneapolis for a long time, but historically, there's always been this premium where the numbers just weren't quite juicy enough for us, and we already had the bulk of our infrastructure or all of our infrastructure over in St. Paul. And even though it's only a few miles apart, without any traffic, it's 8-10 minute drive from downtown St. Paul to downtown Minneapolis, but rush hour that quadruples. And so it was always a little tough to make that jump into Minneapolis initially, just for the logistical reasons. But with this new partner that we have that's got a robust property management team on the Minneapolis side of things, it made a lot of sense. So that's why it's called Origins, the first.
Okay. All right, cool. That sounds good. So let's kind of move in and kind of talk a little bit about the finance side of things. So how did you end up putting the debt on this property?
Yeah, so we're using a local regional bank for this one. We typically like working with those guys just because of the flexibility that they provide for us, the ability to pivot and change our plan if things change from a macroeconomic perspective. That's pretty valuable for us. So we did a pretty standard 75% loan on this one. I think on this one we got, what was it, about 3.29%. You could do better out there, but honestly, the flexibility that we get with these guys is very valuable these days, where things are a little different than they were a few years ago. So we get a little interest only on the front end as well, 25-year amortization, fixed for 5.
Fixed for 5 years. How much IO did you say you had?
We did 1 year on this one for 34 units. We don't really need a ton. We'll honestly probably get through the vast majority of those units within the first 12 months. So,
okay. And you said it was a 5-year balloon?
10-year term. So it's fixed for 5, resets at year 5. And then the balloon would actually be out in year 10. Okay.
All right. That sounds good. And what about prepayment penalty?
I believe this one was 321.
Okay. So basically after the first 5 years of fixed, there's no prepayment penalty. There's no penalty.
Yeah, correct. And if there's a refinance or something in there, if we refinanced into agency, there would be a prepayment for that. But if we did a refi with the same bank, then there's no penalty for that. So
okay, and that you can do that at any point during the 5 years.
Yep,
they won't charge you.
Yeah.
Okay. All right. That sounds good. And talk to me about the investor side of things. So how much money were you raising? I'm assuming from the numbers. Let me see if I can guess this right. You were probably raising somewhere between about 1 to 1.5.
Yeah, 1.5 exactly.
Yeah, okay.
Our model is that we like to raise the capital needed for all the improvements, as well as reserves and operating funds, things like that. So we come in very well capitalized on every deal that we do. We try not to over leverage and add any extra debt for the construction component. That does bring down the pro forma returns because your denominator gets a little bit bigger, but reduces the risk profile significantly.
Yeah, no, I definitely like that for sure. So 1.5 million. And how did you end up structuring that with investors, and how did you end up raising that?
Yeah, so it was a 75-25 split. We try to keep our deals, pretty basic, pretty understandable. We're still kind of newer in the grand scheme of things as far as how long we've been around. So we try to structure things so that they're quite favorable for the LPs, because we're not really trying to get as rich as possible on every deal. Personally, we're trying to really build up a lot of goodwill and make a lot of our investors happy so that they keep investing with us. So 75-25 split, we had a 7% pref, no waterfall or anything like that, just the pref. And then, no matter how good the deal does, that 75-25 split stays. And, if we do a refinance, people are still in there for the same percentage ownership. I know some groups will kind of treat a refi as a buyout almost, but if people own 5% of the equity on day one, we do a refi, they get half their money back. They still own 5% of the equity up until we sell the property. So it's structured very nicely for LPs.
And do you have a kind of projection or kind of plan of how much capital you're going to be able to give back when you do the refinance?
Yeah. So as far as general returns are looking, we like to project 2 scenarios every time we do a deal. We do what's called the base case, which is kind of, all the pessimistic assumptions built in. And then we do what's called our stretch goal, which is really what we think is more likely. And then we call it stretch just to kind of, we still want it to feel like a stretch for the investors because we like to under promise and over deliver. But in our minds, we know that the stretch goal is really what we think is the real outcome, as opposed to kind of setting the expectations reasonably. But yeah, on this one for the refi, the way we have it built out in our pro forma, looks like we are doing about, quick math here, percentage of capital returned is projected to be about 60%. And that's assuming we do it in year 3. If we do it in year 2, if we get to that point, it'll probably be a little bit less than 60%, but people get it back sooner. So we're going to kind of weigh our options depending on what the Fed's doing. If it looks like things are going to be changing quicker or later, there's a lot of factors kind of take into consideration as far as when we actually do the refi.
Because in that year 3 is where the prepayment's down to 1%, correct?
Yeah, but for the refi, if we do it with the same bank, they wouldn't charge a penalty for that. It would really just be if we refied into like a Freddie product or something like that.
Yeah, like a Fannie or Freddie. Yeah. Okay, that makes sense. And so, how did you end up raising this money?
Well, actually, the partner that we brought on board for this acquisition had a lot of people in his network that were chomping at the bit to do these kinds of deals. He was kind of the first one in their network to get into this, and we've had a pretty big pool of investors that we've been working with for the acquisition of all the St. Paul properties. But this was primarily a lot of the investors coming in from this new partners network. So, we set up calls with everybody in his network, just put it on the radar as far as what we were looking for, what we're doing. And so we had a lot of people warmed up to this concept. We'd spent January through, well, now we're still doing it, just having initial calls with everybody in his network, just kind of explaining the business model, explaining the concept from a really high level, and giving people plenty of time to do their due diligence on us, have their lawyers look at PPMs from past deals, and spend a lot of time really just kind of unpacking it slowly, so that by the time this deal popped up, people had been waiting for a while. So this one filled up pretty quickly. There's a handful of people that put in some larger dollar amounts, but on average, I think people were putting in about 100,000 or so. So got a small sized group in this one, but I think it's a really good first deal, just because it's right up our alley. It's exact same thing we've done so many times before. So it just feels good. It feels comfortable.
Great. So you had right about 15 investors in this one?
Yeah, I think it was actually more like 12 or 13. There were a couple larger ones in there, but yeah, something like that. Yeah, it's a good sized group, but there's still, more people from his group that are looking for more deals. So at this point, it's just got to find good opportunities, which is like trying to find needle in a haystack these days.
Oh yeah, for sure. Can you think of anything else that we maybe haven't touched on yet that might be interesting for us to talk about with this acquisition?
Yeah, I think, the one thing that would be noteworthy, I think, is just the whole Minneapolis component. It's been a while now, but, you go back to May of last year, Minneapolis was being talked about quite a bit for not the best reasons. And there were a lot of people that, looked at what was going on there, and it ended up spreading, across all the US. There was all sorts of unrest going on. And that's pretty much settled down. But there was a lot of people that kind of looked at Minneapolis and said, "Ooh, I don't want to go there right now." It's a great market here. We've got actually more Fortune 500 companies in Minnesota than anywhere else in the U.S. per capita, I should say. So just from a job market and quality of life perspective, this is a really amazing market. But people kind of got a little bit of a stigma attached to Minneapolis. So I think the most important thing to note with this one is that it really kind of comes in at the way I like to describe this one is it's kind of like buying the dip, right? If you go back to 2020 and try to, pick up some shares of some decent stocks around March or April when things were bottoming, you did pretty good. And so we finally got this little pullback in the market where people got a little nervous about Minneapolis. And, this deal is a perfect example of just being in the right place at the right time and having a long-term mindset and not getting too concerned or emotional about a lot of headlines and things going on, when in the grand scheme of things, 12 to 24 months from now, everything is going to be 100% normal, and it's going to be just like it was before. So I think that's really the best way to describe this deal is really playing the resurgence of Minneapolis. Really great market. We got this little opportunity to go in and finally go on a shopping spree while there were some weaker hands that were kind of a little standoffish. So
Sure. Well, Dan, thank you so much for spending some time here with us. How can the listeners reach out to you if they have further questions for you about this acquisition, or maybe they want to just continue to follow you more?
Yeah, absolutely. So invictusmultifamily.com is our website. My partner actually just published a book recently, really amazing book, Passive Investing Made Simple. It's just a 101 book for people who are kind of interested in being passive investors and being LPs. Just explains the business model in a really basic way. Thepassiveinvestingbook.com, also really good tool for other operators. If you guys want some kind of tool to give your investors as a gift to help them go through that learning curve, perfect for that. Thepassiveinvestingbook.com, you can find that there. Otherwise, just search for our podcast, Multifamily Investing Made Simple. Pretty much anywhere podcasts can be found, you'll find us. And then, podcast, LinkedIn, Instagram, Facebook. You can find us on any of those places. Dan Krueger, search for me or my partner, Anthony Vicino.
Awesome. Well, again, thank you so much for being here with us, Dan. Looking forward to continuing to follow you and the rest of your group as you continue to close more deals, and also to invite you back on for another episode.
100%. I appreciate you having me. It's been a blast.
All right. Thank you so much. I appreciate it, Dan.
Alrighty. Thanks, man.